Let's talk markets. Let's understand the way forward for markets, valuations, liquidity, and more importantly, financials. Why I'm insisting on financials? Well, if you follow ET Now, Ravi Dharamshi on ET Now about a year ago came out and said the following: I've sold IT, but I've bought into financials. And guess what? Financials have worked like a charm. So what are the themes he's betting on? Where does he see markets are headed? And is it time now to take some chips off the table, given that we've had one of the best summer rallies of 2023? So Ravi, fantastic to have you back now. So Ravi, it's pouring and raining. It's pouring and raining on streets of Mumbai, on Dalal Street, and for every investor who's kept the India faith alive and kicking.
Absolutely. I think we are fortunate to be hitting new all-time highs at this point.
Okay, Ravi, let's start again. We had a bit of an audio problem. So let's start with why markets are up. And how would you rate the margin of safety, given that right now it is more about liquidity and global strength?
So, good morning, Nikunj, and sorry for that audio trouble. But I think, see, we are at a new all-time high, but mood is not at all euphoric around. It's one of optimism. One cannot deny that. But at the same time, somebody who has lived through 2003, 2008 cycle cannot forget the kind of euphoric feeling was there. For 3, 4, 5 continuous years, market keeps giving you double-digit return and keeps building on that. It is then you start making decisions based on the returns that you've made in the market. Based on your M2M, you start and go make car purchases, home purchases, and all that. All those kind of things are yet to pan out. So I think this rally is good to continue from here as well. It's based in solid fundamentals, and we have not yet moved away too much from those fundamentals.
So Ravi, it's important for us to understand that what is the definition of euphoria and what is the definition of participation? How do you discuss and how do you judge that?
No, so just to give you a sense and perspective, FIIs at peak have owned about 25% of India's market. And just a month back, their ownership had dropped to almost 17%. That tells you, right? 17% barring the global financial crisis is the lowest that they have owned since FIIs were allowed to participate in Indian market. So where is the ownership on the FPIs? One can say that, okay, everybody is bullish on financials, but at the same time, financials, the NPA cycle has just turned around. The growth cycle, the credit growth cycle has just picked up. There was some amount of margin pressure due to increase in rates, but even now, RBI has paused on the rates as well. So the fundamentals are good to continue from here. The overall capex cycle is picking up now. I think it's too soon to worry about any kind of over ownership or overvaluation or overheating of the market. I think these things come after a sustained period of rise in the market. And honestly, our last 5-year returns are probably like in 10-11% kind of CAGR. That is not something that you would say is euphoric by any measure.
I'm going to put this data out just for the benefit of our viewers. Ravi referred to this data. We've looked at markets from COVID, the institutional activity from COVID. Now hear me out. From COVID, domestic institutional investors have been net buyers to the tune of 4 lakh crore. But foreign institutional investors have been net sellers to the tune of about 2.8 lakh crore. So net, post-COVID, India may have emerged as the destination in terms of resilience, growth, China +1, stable democracy, coming out of COVID clean, managing inflation the right way. But frankly, foreign institutional investors, the point what Ravi alluded to, they've turned their back towards India. So Ravi, it's a simple maths. What if the selling only normalizes? 50% of that also comes back. That means 1 to 1.5 lakh crore could easily come back.
I would presume that we are going to get double of whatever was sold. Forget half of it coming back. In the first month itself, which was the May month, we got $5 billion. And again, in the month of June, I guess the number is somewhere closer to that $5 billion. We have had almost $8 billion plus of selling by private equity players, promoters. So many block deals have happened and everything got absorbed. And none of those deals happened at any kind of a discount. They were at 1-2% kind of a discount. So no doubt there was supply in the last 1 month, but obviously the flows coming into the equity markets were far stronger than the supply coming in. So that tells you that there is an appetite. The lack of discount tells you that it's not like promoters are exiting at the peak of the market or any such thing. I think it's a misnomer. I think people are trying to, of course, readjust their portfolio, and maybe it is either deleveraging itself, or maybe the trust in the market is not there, which is what is leading to some of the players exiting, or some people have other compulsions like their fund is coming to an end, so take the exit while it is available. But honestly, I think these have been fair deals from the point of view of the buyer as well. They will make money on that, and $8 billion is not a small amount. Indian market now provides the depth like it has never provided. In the global financial crisis, $15-16 billion of selling led to a 60% fall. A $40 billion selling in the year 21 led to 15-17% fall. Everybody is getting an exit, PE player to promoters. Now, what is that doing is that is actually popping up on most FPI's radar as a market that has the depth. We have the domestic institutional capital pool available to absorb the kind of outflows that happened in FPI. Another thing, India has always been the top performing market in the 3, 5, 10-year period in the top 3. So we are providing returns. We have also provided opportunity to generate alpha. Most number of multi-baggers have come from Indian market. So we provide returns, we provide alpha, and we provide depth also. So this is a market now, in my opinion, after US, the number 2 market in the world where people will want to have an exposure. And even today, the sovereign wealth funds, long only pension fund, endowment fund, their exposure is, in their scheme of things, is barely less than 1%. So even if they were to match the MSCI index, there's a huge scope for a lot of money to come in. And now India has the ability to absorb those kind of flows. So I actually tweeted a few days back that get ready for $100 billion inflow. And I think that's going to happen. I don't know whether it will happen this year, next year, but for sure we are going to have $100 billion kind of an inflow.
So Ravi, why is that this time the set of stocks which historically have gone higher are not participating? Reliance, Infosys, it's Tata Motors and HDFC. If flows are coming back, would they be hunting different opportunities, different sectors? Because that's what happens, they say in the market. I mean, courses remain the same, horses they change.
No, so seasonality to seasonality, water will find its own level, and water will flow to where the opportunity lies at that point of time. Again, nothing against a particular company or anything, but whichever my personal area where I believe that the opportunity is essentially domestic focused sectors. We are not so bullish on the global markets. We are not so bullish on the global export opportunity, and we are more bullish on domestic opportunity. So financials, auto ancillaries, then manufacturing, energy transition related plays, discretionary consumption, which currently is undergoing a kind of a soft phase. But these are the areas to focus on with the next 5 years point of view, where maximum alpha can be generated, because the profit pools are kind of still very small in conjunction with the opportunity that is coming up.
Okay. Ravi, there's an extraordinary, I won't say event, but a big merger, HDFC Limited and HDFC Bank, which will have ramifications for everybody. Markets, flows, for the banking sector per se, because balance sheet size is so large. It's now the 4th largest entity in the world. What could be the implications of this on flows, on markets and the sector per se?
So it cannot be anything but positive overall. We finally have a company, now more than one company is there, which can be a global leader. When Apple market cap is hitting $3 trillion, and the largest company out of India is roughly about $140-150 billion, that tells you the kind of size difference there is. See, India is a small cap in the world. We are roughly about $3.5 trillion in a world market cap of more than $105-110 trillion. So at 3% of world's GDP and 3% of the world market cap, we are a small cap. But now we are showing the ability in every which way. Markets are coming of age. The companies within India are also coming of size and age, where people who want to take $200-500 million, maybe $1 billion kind of a stake, that is also possible. So I think over a longer term period, this behemoth will become a must own for most of the large global funds. So, and it is, I mean, I'm very glad this is a group that you can, hold at the highest in terms of corporate governance standard. So absolutely a draw for overall capital into India. And I think that's the beacon of Indian market.
Okay, I'm going to put this quote out of Mr. Sashi Jagdishan, and this is something which he's written to employees and shareholders. We could be creating a new HDFC bank every 4 years. Now, Ravi, on a balance sheet size of it's the largest combined balance sheet size now. They are looking at doubling in next 4 years. For HDFC Bank to do that, do you think it is going to be a pure market share gain, or it really could be a pure growth in India which they will capitalize on? When 4 years double on that balance sheet size is incredible.
No, but those are the kind of numbers. I mean, if India is going from $3.5 trillion to $5 trillion economy, a company like HDFC Bank can definitely grow. It is not beyond the realm of possibility to grow at 18%. And I think that is the beauty of Indian market, where the largest company can also grow its top line at between 15 and 18%, and the bottom line has a possibility to grow higher than 20% also. So, I mean, coming to your point, I don't see that as a challenge. Of course, the final delivery will depend on what happens, but it is not that, while most of the profits for the American companies, about 30-40% come from outside of US geography. For Indian companies, mostly it comes from the Indian geography itself. And in India, if India is growing at 10-12% nominal, a bank like HDFC Bank can grow at 18%. So I think it is very much possible, and it will happen. So give or take 6 months or 1 year, but it is going to happen.
So Ravi, what else to your mind right now is in that curve of high growth and attractive valuations? Because that's the perfect combination. Get it right on price and bet on the growth because future is bright.
So within financials, of course, we've been bullish on the lending companies, but non-lending financials are also at a very interesting juncture. See, India has brought into its fold almost 40% of the unbanked population in the last 5-7 years. There is a move away from hard assets, physical assets like real estate. Real estate and gold form a disproportionate portion of the majority of Indian households. Now there is a move away from it towards financialization. So there a lot more money is going to flow into financial products. So non-lending financial companies are at a very interesting juncture. And whether I say it's the insurance companies or the wealth managers or the capital market related plays, these are all still suffering from the correction of the last 2 years or the last 3-4 years, where there were some regulatory kind of pressure on the company, or there was exceptional pressure on the yields, which was leading to the companies not performing. Now, some of the pressure is relieving, like we saw in the case of AMCs, that, okay, the regulator took a pragmatic view and decided to hold back and take the industry's feedback. So just like that, on the insurance front also, there was a hang on the a particular company from promoters selling. They took back. So all those overhangs are now going away, which is leading to this space also suddenly becoming very, very attractive. So I would say within the financials, non-lending financials are probably at a slightly better risk reward at this juncture.
So would you be looking at doing the following: reduce the exposure to corporate banks and maybe shift towards AMC or insurance or NBFCs, or you've already done that?
No, we are not looking to reduce the exposure on the lending side, but we are definitely looking to increase the exposure on the non-lending side. So it is not a either or call for us. In fact, we are bullish on both the spaces.
So you'll have to sell something to buy something, because that's how portfolio allocation works, right? So what would you be selling?
We are lucky we are getting inflows, so we don't have to really sell anything. And just like all the money is coming into the market, we are also getting some good flows, and that is leading to us increasing exposure on the non-lending side. But having said that, of course, yeah, we are at the margin. Some of the stocks that have done brilliantly over the last 6-12 months, we are trimming a little bit and creating space for some new bets.
You were bullish on manufacturing, you were bullish on alternate energy, you were bullish on financials. We've discussed financials. What about the other two themes? Especially energy transition. We spoke with you when we had visited the factory of Wari. What is the update there? What is happening in that space? Because now it seems to be the pet theme for everybody.
Yeah, I mean, I think this is a theme that is going to sustain for another 10 years, maybe more also, but let's speak about next 5-10 years. And if that is the case, solar is going to be the backbone. In fact, other places like wind are also doing well within that theme. So, as a investment opportunity, still it has not opened up for the listed market investor. There are still some bets available on the unlisted side. Listed space does not lend itself to investing. So the theme is there. We'll keep our eyes and ears open to see where the opportunity arises, but one has to be constantly focused on this space because the maximum amount of money that is going to be spent in the world in the next 10 years is in the energy transition space. So the opportunities will come. You keep your eyes and ears open.
Talk about manufacturing, and some of the EMS stocks have done rather well. Public information, some of your portfolio companies have done rather well. Do you think this EMS space is now looking like a mini frothy bubble, or it has a long way to go?
So as I mentioned earlier, clearly, there has been some returns have been far sooner and far more than what we had expected. But at the same time, the absolute size of these companies are still very small. See, they are all within the range of 1,500 to 2-3,000 crore kind of a revenue company and 100 to 200 crore kind of PAT. I feel these companies are going to go to minimum 500 to 1,000 crore kind of a PAT over the next 5-year horizon. So you can have 6 months of underperformance of any such thing, but I don't think it's the time to get out of this space. These companies will become far bigger from here as well. Manufacturing overall is at a cusp where we are witnessing a gush. The order books are filling up very, very fast. The conversions time is reducing dramatically, and companies are able to pitch to the best against the best in the world and yet win orders. So that tells you that Indian manufacturing is really, really coming of age. So I will not be in a hurry to call the top of the theme so soon. If you see, I mean, it started in 2014 with chemicals. Chemical manufacturing was the first one to pick up. That theme ran for 7 years, and most of the companies, the worst performing stock in the sector was a 10 bagger. The best performing was probably a 150 bagger. So with that kind of returns in the offing, why would you want to sell just because it has gone 2x 3x in a very short span of time? So we are very, very bullish on the manufacturing space. Within that electronics manufacturing space, the entire sector will grow at 25% CAGR. Possibly some companies can grow at 35-40% CAGR with inorganic also. So far larger companies are going to be coming out of this space with a far bigger profit numbers. So let's wait and see how this space evolves.
Ravi, interest rates globally have not peaked out. It could be 25, it could be 50, we can debate. But bottom line is that rates have not peaked out. And typically when rates have not peaked out, equity should not do well, growth stocks should not do well. But the reverse is happening. AI stocks, chip stocks, fintech stock, consumer stocks, they've all gone higher when interest rates are likely to go higher. So do you think we've got a reversal in, because that's what I've learned and understood over the years I've interacted with folks like you?
So the lead indicator towards all the data is pointing to inflation cooling down. In fact, inflation has cooled down, whether in India or whether globally also. Of course, the overall US economy still remains stronger. The jobs market still remains tight, and the consumer optimism is just about beginning to wane. So I believe that Fed is on the wrong side over here by extending the hike. They are essentially engineering a slowdown because the economy is not slowing down on its own. So they will get what they want, which is a slowdown. But at the same time, a mild recession or a slowdown is actually a positive for a country like India because we will be probably one of the few sole growth engines in the world. Even China, the post-COVID rebound in China is not that strong. And also the China plus one, whether it pans out in the manufacturing side or no, but on the capital market side, it's already panning out because funds are looking for an alternate markets to deploy their fund outside of China. And they are so badly burnt in the last 3-4 years that nobody wants to go back to China. So I think China plus one is playing out in the Indian equity markets, and inflation in India has peaked. RBI has paused. So from an Indian markets investor point of view, I think it's far more clear. From US markets point of view, we are not yet clear whether it's 25 or 50 bips, but one can very, very clearly say that after that 50 bips, I think we are done. So not trying to guess when it ends, but at the same time, how does that extra 50 bips matter? There will be pain in the US market for sure. Whether it is in the regional bank it shows up or where it shows up, we don't know. Whether in the consumer spending it shows up, it will show up. And that is precisely why we are not bullish on the export-oriented sector.
Ravi, at what point in time markets will start getting worried about the next election cycle? I mean, it's a year away, but there would be a time when every second question or every second thought would be centered around that.
So I have a feeling that we are going to go strong into the election because there is a high if you want to bet on the outcome of an election, which I don't recommend, and neither one should bet, but this is the time to bet on it, that election will be positively in favor of the current incumbent government. And at that point of time, probably even if the outcome was not in the favor, then maybe 2 months prior to that. But if it was in favor, then probably post the event is where you will likely see most profit booking.
And before we wrap, Ravi, what we've discussed are B2B businesses, manufacturing, solar. What about owning some of the B2C names, watch companies, car companies, pizza companies, liquor companies? I haven't heard that word from you.
So as I said, currently the discretionary consumption is undergoing a little bit of slowdown, and primarily urban consumption. I believe rural consumption is about to pick up, and urban consumption is also probably going to pick up 6-12 months down the line when the current overstocking is out of the way. I think there was a pent-up demand post-COVID, and that led to a very, very high numbers. Now that is in the base, so we have to wait until that is out of the base, which will be 6, 9, 12 months down the line. Overall, if India's economy is going from $3.5 trillion to $5 trillion, for sure consumption has a big role to play. There will be a consumption J curve, which we have been waiting for since forever, is finally on the anvil, according to me. In the next 5-10 years, we will go from being a $2,500 per capita to $4,000 per capita. And if that were to happen, the kind of money that will come into discretionary spending, and we can already see, some of the sectors where supply has not been created, whether it is the airlines, hotels, that the kind of price increase is just crazy. So we will see this discretionary consumption boom showing up from time to time in various sectors, and it is a secular theme. Use the current slowdown in the space to build upon position.
I'll summarize today's interaction, and perhaps the most important point for us was the starting point. And if I say that Ravi Dharamshi is of the view that right now markets are not euphoric, there is no bubble, there is no risk of valuations. If a correction occurs, it could be seasonality, it could be liquidity, but fundamentally speaking, if you are long India, do not sell in India just because markets have run up. Can I summarize today's interaction?
I would say absolutely. Just a little bit of caveat, a 5% correction cannot be ruled out at any point of time, 5-10%, but that does not mean that the trend is changing.
Really fantastic to have you back. Thank you for joining us. And for a change, we've not discussed pharma. We'll keep that for the next time. All right, let's take a break. Are we taking a break? No, we're not taking a break.